In every major economic failure of the modern era, one common pattern could be traced. Individuals who managed to build wealth for generations ahead did not succumb to the chaos of the downturn. They prepared methodically long before it arrived. Throughout recent decades, the dominant financial discourse has hammered home the same line of behavior. Economic crises are impossible to predict with precision. The only defense is broad portfolio diversification. Any effort to accurately determine the timing of market entry inevitably leads to losses. This doctrine is quite applicable to a certain category of market participants. However, it was by no means intended to serve the interests of another group. This second group, whose quarterly SEC filings and confidential analytical reviews of asset status paint a fundamentally different reality, has followed a precisely calibrated strategy of action for more than a century. This strategy is activated not at the moment a market crash begins, but approximately 18 to 24 months before its inevitable onset. Below, we will analyze 5 key positions that invariably feature in this repertoire. One of them is formally available to absolutely everyone. A tiny minority is aware of it. The 5th position represents an institutionalized mechanism through which a legal transfer of capital from the middle class to ultra-elite wealth holders has occurred in every documented major downturn of the 20th and 21st centuries. Asset number 1. Let's analyze the position that seems most trivial at first glance, since in the lexicon of institutional capital, the term trivial is often equivalent to the term strategically foolproof. Before the dot-com collapse in 2000, before the global financial crisis in 2008, and before the COVID-19 pandemic shock in 2020, the same pattern of behavior was invariably observed in the Form 13F filings with the U.S. Securities and Exchange Commission (SEC) of leading institutional investors. They refrained from aggressive gold purchases. They did not rotate into the real estate segment. They did not flow into commodity assets. Instead, they systematically accumulated short-term government securities, treasury bills with a 90-day maturity, bringing yields only slightly higher than standard savings account rates. By mid-2023, Berkshire Hathaway, controlled by Warren Buffett, had placed more than $130 billion in such T-bills and cash equivalents, long before the escalation of the regional banking crisis and before the start of the correction in commercial real estate. Financial media stated in unison that opportunities were being missed, accused him of excessive conservatism, and claimed that the legendary investor had lost his former sharpness of intuition. The reality turned out to be different. He was methodically preparing an arsenal for a strike. This reflects a fundamental difference between the behavioral model of ultra-high net worth individuals and stereotypical recommendations for personal finance. For the elite, liquid funds in the form of cash are not perceived as a source of missed returns. On the contrary, they are viewed as the only asset class capable of instantly converting into any other instrument at the exact moment when alternative assets are experiencing a phase of acute price depreciation. Analyze the historical dynamics in the period from 2008 to 2009. The S&P 500 index lost about 57% of its capitalization at its bottom. If an investor had $10 million in treasury bills with a 2% yield, they would have received $200,000 in passive income, while other market participants lost half of their investments. But the key advantage lay not so much in this income as in having the full amount available in conditions where outstanding enterprises were offered at prices twice as low as their fundamental value. The Knight Frank Wealth Report for 2009 recorded a sharp increase in so-called liquidity preference among ultra-high net worth individuals starting in 2006. These individuals were not retreating into the shadows, they were taking advantageous tactical positions. This is why the aphorism, "be in the market, time in the market beats attempts at timing," contains a grain of truth. It is effective for the typical retail investor, but it was originally constructed for those whose capital movements in the volume of $500 million in T-bills instantly become a noticeable signal in the market. For everyone else operating standard brokerage accounts, there are no institutional obstacles to replicating Buffett's maneuver. There is only psychological inertia, suggesting that such an elementary step cannot be truly effective. The mechanism rests on an unshakable postulate. Market downturns generate forced sellers. Sellers need buyers. Buyers need powder, liquid funds. The ultra-elite accumulate an instrument immune to the destructive impact of the predicted event. They then wait with the endurance of a person already familiar with the script. Asset number 2. We move on to a position, the understanding of which is fundamentally undesirable within the framework of the traditional financial paradigm. For a full comprehension of this dynamic will allow one to recognize in every major economic upheaval a simultaneous mechanism of value transfer. And this transfer is strictly unidirectional, in one direction. The second asset is distressed debt obligations. As a company approaches a state of bankruptcy, its publicly traded bonds experience a catastrophic devaluation. A bond originally issued at a par value of 100 cents on the dollar may be quoted at a level of 15 to 20 cents, and sometimes even lower. The market, gripped by panic and deprived of liquidity, discounts these instruments under the hypothesis of total default. No one wants them. Retail investors have evacuated. Financial publications publish obituaries. At this moment, institutional capital enters the stage. Howard Marks, chairman of Oaktree Capital, built one of the largest firms for alternative assets almost exclusively on this doctrine. His memorandum to clients from October 2008, written against the backdrop of the universal market collapse, is now part of the mandatory graduate program in finance. Marks' central thesis states, investments in distressed debt are not a speculation on the survival of the issuer. It is a legally formalized channel for acquiring a company's assets at a price significantly below the cost of their reproduction, without the need to purchase shares. Let's analyze how the mechanism works, an aspect that mass media systematically present in a veiled form. In a bankruptcy procedure, there is a strict hierarchy of creditors determining the order of satisfaction of claims. Holders of senior secured debt are at the top of the pyramid. Junior bondholders are below. Common shareholders occupy the very bottom, and in most cases receive zero recovery. The bankruptcy court carries out restructuring. Old equity capital is completely canceled. Holders of distressed debt, purchased at 15 cents on the dollar, convert their claims into new shares of the reorganized entity. They did not acquire equity. They held debt, and they came out as owners. In the 2008-2009 crisis, this process unfolded on an industrial scale. Specialized distressed debt funds accumulated the obligations of auto industry suppliers, commercial real estate trusts, and retail conglomerates declared dead by the market. General Growth Properties, the second largest shopping mall operator in the U.S. at the time, initiated bankruptcy proceedings in April 2009. Its debt securities were trading for a pittance. Brookfield Asset Management formed substantial positions in these instruments. By November 2010, at the conclusion of the bankruptcy procedures, Brookfield acquired a controlling stake in a company managing more than 200 shopping malls with a combined value of billions of dollars. The total entry price, distressed bonds at a fraction of their nominal value. The Capgemini World Wealth Report for 2010 documented the fact individuals with high capital who maintained an allocation in alternative credit strategies during the 2008 crisis outperformed standard diversified portfolios by an average of 23% over the following 3 years. Not due to intellectual superiority, but thanks to access to an instrument structurally inaccessible to retail investors because of regulatory barriers, minimum entry thresholds, and artificial opacity. A darker side of this mechanism may alarm the observer. Distressed debt requires a distressed economy to generate its raw material. From one perspective, every corporate insolvency during a downturn means the loss of jobs, pension savings, and wealth for thousands of individuals. From another, it is a transfer of productive assets, including manufacturing facilities, logistics chains, and real estate portfolios, from a dispersed pool of public shareholders to concentrated private capital at prices below market value. The legal architecture of modern bankruptcy did not declare this outcome as a primary goal. However, empirical results are far from neutral. Recognizing the existence of the mechanism is the first step toward understanding in whose interests the financial infrastructure is optimized. Asset number 3. The third asset is the oldest of those listed. It is older than organized stock markets, older than the bond market, older than central banking institutions. It has survived all the downturns on our list and all the cataclysms preceding them recorded in historical chronicles. Currently, the rates of its accumulation have no analogs in modern history. We are talking about productive agricultural land. The Knight Frank Wealth Report has monitored the farmland index for over a decade. Between 2000 and 2020, the value of prime agricultural land in the United States more than quintupled, an increase of over 500%. This asset class did not slump during the dot-com collapse. It did not buckle in the 2008 financial crisis. During the COVID shock of 2020, when real estate investment trusts, REITs, lost 40% and commercial real estate entered a long correction phase, farmland instead gained 7%. The explanation is elementary. Land that provides food production has a built-in price floor inherent to no other asset classes. This floor is called caloric necessity. Humanity's biological need for calories to maintain vital functions remains regardless of the incorrect pricing of risks by central banks or the insolvency of over-indebted financial institutions. In 2023, an investigation by the Land Report, confirmed by records from the U.S. Department of Agriculture (USDA), revealed that Bill Gates had accumulated approximately 270,000 acres of American farmland distributed across at least 18 states, making him the largest private landowner in the country. Mainstream media presented this as a whim of an eccentric tycoon, or in conspiracy circles, something more sinister. Financial logic, on the contrary, is elementary and archaic. In the agrarian economy of the Roman Republic in the 1st century BC, patrician classes systematically consolidated public lands during periods of debt crises. As small farmers defaulted on obligations they could not service, latifundia, giant estates of the senatorial elite, spread across the Apennine Peninsula. A similar pattern emerged in post-plague Europe of the 14th century, where liquid survivors bought up abandoned farms from the estates of the deceased at bargain prices. In Germany after World War I, during the hyperinflation of the Reichsmark, which reached total devaluation, foreign speculators and local industrialists with hard currency acquired agricultural lands from middle-class families who had lost the real ability to service mortgages. Identical mechanism, different eras. A critical difference, confirmed by forensic data from all crises, lies between land for export crops and purely local ones. In Venezuela, after the currency collapse of 2015, fields for coffee, cocoa, and tropical fruits with dollar-denominated offtake contracts maintained real value. Urban commercial real estate, denominated in bolivars, turned to zero. One asset was tied to global demand, the other to a monetary system that had ceased to exist. The asset represents not just soil, it is a productive capacity tied to demand that transcends the jurisdiction of any local currency in a crisis. Asset number 4. Visit the private deals department at the New York branch of Sotheby's 4 to 6 months before a major market dislocation, not the public auction halls. This is the closed sector, accessible exclusively by prior appointment through referrals and personal connections. Private data from Sotheby's and Christie's demonstrates a steady pattern for nearly 50 years. The volumes of private treaty sales, direct negotiations between collectors and institutional buyers outside of public auctions, increased exponentially in the 18 to 24-month interval before major downturns. Before the 2008 crisis, such deals reached record volumes in 2006, 2007. Before the dot-coms of 2000, in 1998-1999, the pattern was repeated at the end of 2019 and the beginning of 2020. This is not a coincidence. It is a behavioral characteristic of the blue-chip fine art class, not reproducible by financial instruments. The correlation with equity markets tends towards zero. A fundamental study by May Moses, subsequently integrated into Sotheby's, based on 200 years of auction archives, provided an unambiguous conclusion. Fine art returns demonstrate a negative correlation with financial crashes. When the S&P 500 lost 57% in 2008-2009, the elite segment of art, works by recognized authors with unquestionable provenance and steady collector demand, corrected by only 4%. 4% versus 57%. The mechanism of this stability is not related to aesthetics and is entirely determined by the rigidity of supply. A work by Gerhard Richter cannot be produced at the whim of a central bank. There is no analog of quantitative easing for art. The supply of key works by historically canonized authors is fixed in the most literal sense. The artist is dead and creates no more. In conditions where the emission of fiat money can grow by $3 trillion in a month, as happened in March 2020 by the decision of the Federal Reserve System, any asset with a permanently limited supply turns into an instrument for preserving value by structural necessity. Capital rushes towards scarcity that cannot be printed. The mechanism of private treaty sales adds an additional layer rarely highlighted publicly. Public auctions are transparent in terms of pricing and are subject to market moods. Private negotiations are devoid of this. In periods of financial stress, the parties conduct direct bargaining. A seller needing liquidity to cover losses in other assets agrees to a discount below market quotations. The acquirer fixes the deal at a price not reflected in public indices, not tracked by standard reporting, and structured through complex accounting schemes. The opacity of transactions is not a side effect of the strategy. For the ultra-high net worth community, it is a core feature. The Capgemini World Wealth Report has consistently noted since 2010 that allocations in passion investments, fine art, rare wines, classic cars, colored stones, make up 5 to 10% of global UHNWI portfolios, with a measurable growth in the 12 months before documented stress events. This is not a manifestation of passion. It is the recognition of patterns with a horizon of several generations, masquerading as a hobby. Asset number 5. The final position elevates the entire preceding list to the rank of defensive measures, since the first 4 are means of protection, storage of value, and channels for preserving capital in dislocations. They safeguard wealth. Transfers are provided on the periphery. The 5th asset is a pure offensive operation. It is the instrument through which new fortunes are built in economic collapses, not just old ones preserved. It is hidden in the least glamorous segment of private equity deal flow, monopoly businesses in the sphere of essential services. Forensic analysis of data on acquisitions in private equity after every major crisis of the 20th and 21st centuries reveals a behavioral pattern bordering on algorithmic predictability. In the interval of 12 to 36 months following a market dislocation, sophisticated capital purposefully targets enterprises in sectors with absolutely inelastic demand: waste disposal, self-storage, funeral services, pest control, water infrastructure, medical waste processing. These businesses are united by a property that sounds banal until the moment of precise formulation. Their services are consumed continuously, regardless of the macroeconomic conjuncture. A family that has lost its income continues to generate garbage. They require storage during forced housing downsizing. Pest invasions disregard unemployment data. Mortality, especially in crisis periods, relies exclusively on its own cycles, ignoring central bank policies. The economic profile of such businesses in the downturn phase provides the acquirer with an asymmetric advantage bordering on exploitation. Revenue remains stable. Labor costs decrease because mass unemployment removes the bargaining leverage of workers. Competitors, small operators who financed expansion through leverage, default on debts and leave the market. The acquirer consolidates routes, client bases, contracts, and equipment on terms of a liquidation sale from sellers unable to service obligations. Wayne Huizenga understood this dynamic earlier than most modern players in private equity. He transformed waste management into a national titan not in periods of boom, but by absorbing regional operators in the stagflationary recession of the mid-1970s. No technological innovations, no disruption ideology, no tech superiority. Garbage trucks complete their routes equally stably when GDP grows by 4% or shrinks by 4%. He accumulated assets in moments of seller distress, monopolized the niche in the recovery phase, and cyclically repeated the pattern in subsequent downturns. PitchBook data on transactions in private markets confirmed the repeatability. Between 2009 and 2012, the rates of acquisitions of essential service businesses by institutional private equity accelerated by more than 40% compared to the pre-crisis baseline. Funeral homes, storage operators, water treatment plants, and medical waste processors were bought at depressed EV/EBITDA multiples, while their underlying cash flows remained untouched. This symbiosis leads to the final element of forbidden knowledge embedded in the entire configuration, and this is the most uncomfortable insight. Enterprises ignored by retail investors and financial media in periods of euphoria, boring, devoid of glamour, carrying no cultural hype, not associated with transformation narratives, transform into priority targets for acquisitions in the downturn phase for precisely this reason. Their valuation was not inflated by speculative premiums. Their multiples did not require decades of perfect execution for justification. They were quoted below fair value even in good times. They became available at a symbolic price in bad ones. Their cash flows never stopped. Glamour rules in expansion. Monopoly essential dominates in contraction. The cycle is predictable enough for strategic planning. Thus, the essence of what you have learned from this narrative transcends the framework of 5 assets. Every economic crash in documented history was not a random cataclysm. It was a cyclical event of redistribution. Capital flowed from the unprepared to the prepared, from the impulsive to the methodical, from passive holders to positioned acquirers. The middle class was told that downturns are inevitable disasters that befall them. Empirics from SEC 13F filings, Knight Frank reports, Capgemini analytics, and centuries of private auctions with acquisition records tell a different story. Downturns are orchestrated sales for those who know in advance the object of purchase, its rationale, and target price. The financial system did not mask this out of malice. It assumed that the information was actionable only for individuals with access to specialized vehicles. The assumption is wrong. The principles are transcendent of vehicles. Liquidity is ammunition. Essential monopolies are permanent cash flow. Farmland is a caloric claim on the future. Distressed debt is ownership in the guise of debt. Fine art is uncorrelated preservation in a cultural wrapper. Prime brokerage is not required for comprehension. What is required is the willingness to analyze the real actions of generational wealth builders, not their speeches at Davos, not their op-eds in the press, and to formulate one uncomfortable question. If the contours of the next downturn are already casting a shadow on the present, measured by T-bill accumulations, private art deals, quiet farmland purchases, and positions in distressed debt by professionals whose entire lives are geared toward this recurring event, in what point of space do you intend to be upon its arrival? Subscribe if you wish to continue formulating sharper questions.